Thank you all for joining me on this Navigating and Beating Interest Rates webinar. So we're going to be diving into some of the secondary mortgage market, some of the things that formulate interest rates, and we're also going to be talking a little bit about some of the things that you can do to help be able to purchase a home in this current interest rate market environment, because I truly do believe that you are not going to be served by waiting for interest rates to come down before you decide to purchase a home. So we've got a lot of information to cover. It's going to get a little bit technical, so I'm doing my best job that I can to try and explain things at a basic level so that you understand the concepts of how this market works, how interest rates are influenced by the market, and things that you can do to still win in this market despite what interest rates are doing right now. So let's get on into it. First rule of understanding rates. This might seem a little harsh, but this is a business. So you need to leave your emotions and feelings at the door. There is no real estate market as we know it without a mortgage industry. And the mortgage industry does not operate if the players that are operating the mortgage industry are not making money off of it. So this is a business. And that's the first thing you need to understand, because everything else that I explain rather, you're going to see how the money moves throughout the mortgage market and how rates and everything are affected. So now that we got that out the way with, let's go on to the easiest way that I know how to explain it: following the money. Now, again, this is a base tip of the iceberg level. It is very, very complex when you're talking about economics and the market and rates and everything like that. But at a base level, this will give you an understanding of how it works. So you want to buy a home. You go to a lender, and that lender gives you money so that you can purchase that home. You, in return, give that lender a mortgage, and that mortgage is attached to a promissory note, which states that you owe the lender money. It states how much you owe them, what your monthly payments are going to be, what your interest rate is, all of that stuff. So you give that lender the mortgage, and that's how that first part of the sale works. Now, that lender does not have unlimited money or unlimited funds to just continue loaning out money to everybody that wants to buy a home. So that lender, since they only have a limited amount of funds, a lot of lenders don't make their money on holding your mortgage or holding every mortgage that they originate. What they do is they sell your mortgage in what's called the secondary mortgage market. So they take your mortgage, they sell that mortgage to one of many players. In this example, I'm going to use Fannie Mae or Freddie Mac, because Fannie Mae and Freddie Mac are two of the largest players in the secondary mortgage market. Other people can buy your mortgage. It can go to other lenders. It can go to hedge funds. There's a lot of places that can also buy that mortgage that bank or that lender originated for you. However, for this example, we'll use Fannie Mae and Freddie Mac, which are the largest purchasers of mortgages. So they sell that mortgage to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac pay the lender money, and they get your mortgage. So you see how that process works. The banks get money for your mortgage, and they can take that money and go make more loans for people looking to purchase homes. So what does Fannie Mae and Freddie Mac do with your mortgage? Well, they take your mortgage and they package it into what's called a mortgage-backed security. So they tend to take mortgages that are similar, perhaps in risk level, similar in interest rates, similar in several different ways, and they package those mortgages together and into what's called a mortgage-backed security. Now you have investors, and these investors, I'll move this so people can see. So you have these investors, and investors want to invest their money and make a return on their investment. So in order for them to do that, they look at mortgage-backed securities, for example, and they say, okay, we'll invest money into mortgage-backed securities. You've got a group of mortgage-backed securities that are kicking off a 6% interest rate, 5% interest rate, whatever it might be. We'll invest in that. And so they purchase these mortgage-backed securities. Fannie Mae takes that money And that's how Fannie Mae makes money, to be able to thereby purchase more mortgages from the bank. So now you kind of see how this whole cycle works. There's one more component to that cycle. The investors need to get paid the yield or the return on their investment. So that works when you pay your mortgage payment. You make your mortgage payment to whoever is holding your mortgage. In this instance, the investors are purchasing these mortgage-backed securities, so they get the yield or the return on your investment. So when you make your principal and interest payments, those investors get the whatever that interest rate is that you're paying, they get the yield on that investment. And so that's how the cycle works in general for the money flowing with the mortgages. And you might be asking yourself, what does all of this have to do with interest rates? Well, it's good to understand this so you can understand the effect that this has on interest rates. So we'll head on to the next slide. Before I get into the exact effect on interest rates, we'll talk a little bit about mortgage-backed securities. They follow what's called the 10-year Treasury bond. So the green line on top, excuse me, the green line on top are the 30-year fixed rate mortgages or mortgage-backed securities. The blue line on the bottom is the 10-year Treasury bond. And so the 10-year Treasury bond usually tracks below the mortgage rate, mortgage-backed securities. And over here, you have different interest rates. And this goes from January of 2000 all the way through January of 2023. And so as you can see, when the 10-year Treasury goes down, mortgage-backed securities go down. When 10-year Treasury goes up, mortgage-backed securities go up, and vice versa. It's not a one-for-one, so you do have some instances where you might have one going down at a sharper rate than another one goes down. And what that causes is it might cause the spread to be a little bit wider. And the spread is the gap or the distance between the mortgage-backed securities and the 10-year Treasury yield. And so these gray areas here are times where the spread or the distance between these two lines has been 2% or more. So times where it has been greater than 2%, that's where you see the shaded areas. So you see a shaded area here around early 2000. You see a shaded area here around 2008. You see a shaded area here, 2020. If you're starting to pick up these times when you have these shaded areas, they kind of tend to coincide with recessions. Now, we're not in a quote unquote recession right now. However, if you look at 2023, we've got a huge shaded area where we're having a big gap between mortgage-backed securities and the 10-year Treasury yield. So read into that what you may, but there are a lot of economists out there who predict that we might be heading into a recession, and they're looking at some of this same data as well. So that is something that's important to keep in mind, because interest rates have an inverse relationship to mortgage-backed securities and bonds. Like we showed on the previous slide, bonds and mortgage-backed securities are pretty much tied. The 10-year Treasury and mortgage-backed securities are pretty much tied together. They move together. And so they have an inverse relationship. When bond prices go up or mortgage-backed security prices go up, which again, they tend to go up together, interest rates go down. When mortgage-backed security prices or bond prices go down, interest rates tend to go up. So they have an inverse relationship. Now, let's get back to our investors here. We got our investors, and we've got Fannie Mae and Freddie Mac down here with some mortgage-backed securities for them to invest in. But mortgage-backed securities are not the only investment option that these investors have. They can invest in bonds, they can invest in stocks, real estate, mutual funds, index funds, ETF. There are a lot of other investment options that they have to invest in to try and grow their money. And mortgage-backed securities sometimes look like a really good investment. There are other times when those mortgage-backed securities do not appear to be a good investment compared to all these other things that they can put their money into. When it's a good market and everything's going great, maybe these investors want to put their money more into stocks where it can grow at a higher rate of return rather than the lower fixed rate of return that you might be getting with mortgage-backed securities. So It all comes down to supply and demand when we're talking about how these interest rates move. So if there is a large demand of investors wanting to go after these mortgage-backed securities, meaning a lot of investors are wanting to buy up mortgage-backed securities, what that does is it pushes the price of mortgage-backed securities up. And remember that inverse relationship that we talked about. When those prices go up, interest rates are going down. If there is not a lot of demand for those mortgage-backed securities, the prices are going to go down. And when the prices go down, those interest rates are going to go up. So you see that inverse relationship. So what's affecting the price of these mortgage-backed securities? All of these things over here, the price of bonds is affecting mortgage-backed securities, stocks, real estate. A lot of this affects mortgage-backed securities, but there's a lot of other factors in the economy that also affect mortgage-backed securities. The jobs market affects mortgage-backed securities, because let's say that we have a jobs market that is starting to turn south. People are starting to get laid off, lose their jobs, and the unemployment rate is starting to grow and grow and grow. Well, that affects the price of mortgage-backed securities, because people's ability to be able to purchase homes affects the housing market and the mortgage market. It also affects the mortgage-backed securities market, because if you're holding a mortgage-backed security, if you're an investor that's purchased mortgage-backed securities and you're holding these MBSs or mortgage-backed securities, and people start losing their jobs, you get paid when people make their principal and interest payments. So if people are no longer making their principal and interest payments, that means you're not getting paid. If we have a 2008 where people are starting to foreclose their homes because they can't make their payments, and that starts happening to a big level, or a lot of people are starting to not be able to make mortgage payments. They're having delinquencies, foreclosures, and everything. If that happens to a big enough level, we have 2008, where this whole system pretty much collapses on itself, because investors start pulling their money out. They're like, we don't want any more mortgage-backed securities. And I'll go back really quick to show this. If investors are pulling their money out of mortgage-backed securities, that means Fannie Mae's not getting the money to be able to pay these lenders for more mortgages. The lenders aren't getting more money to be able to create more mortgages or originate more mortgages for individuals looking to purchase homes. And so that's kind of what happened in 2008, when everything kind of collapsed with the housing market, was that you had a lot of mortgages that were originated that should not have been originated, because the people who bought these homes with these mortgages could not afford to make the payments. And when you have a large enough number of people that can't afford to make the payments, it affects this entire system. So getting back to where we are here, that's the supply and demand piece of it. So we have investors that have options, and we have investors that are looking at mortgage-backed securities and seeing, is this a good investment for me at this time? So with where we're sitting at right now, interest rates are floating around 8%. So with interest rates floating around 8%, you might be thinking, it's a good time. Why would investors not want to jump in, buy up all these mortgage-backed securities, and get 8% on an 8% yield on the money that they're investing? That's even more than when interest rates were at 5%. However, investors do not believe that interest rates are going to stay at 8% for very long. They believe that interest rates are currently at 8%, but it quickly rose to 8%, and there's a lot of uncertainty in the market, especially with what the Federal Reserve is doing with these constant increases in the Federal Reserve rate and everything. So they do not believe that interest rates are going to stay at 8% for long, and they believe that interest rates will go back down to 6%. So when these investors invest in mortgage-backed securities, they invest in them to hold them and make their money back within about 5 to 7 years. Now, they make their money back sooner than that, but they plan to hold them for at least 5 to 7 years before individuals either refinance or sell their home. And so if you have investors that, let's say you have a mortgage-backed security that is for sale for $100, and you have an investor that's paying $102 for it, they need to hold that for a period of time to get enough interest payments to break even, essentially, or to get back to the black, and then hold it for long enough after that to be able to make money on that investment. So let's just say that they need to hold these mortgage-backed securities for at least 2 years or 3 years to break even, and to make a profit, which is obviously, this is a business, they want to make a profit, they need to hold these mortgage-backed securities for 5 to 7 years. The moment at which you refinance your property or sell your property, they get paid off and they don't get any more principal and interest payments, because when you refinance, a new mortgage is created, and the mortgage that they were holding at the 8% gets paid off completely, so they don't get any more principal and interest payments. If that happens early enough in the time frame that they're holding these mortgage-backed securities, they don't make any money on it. If it happens soon enough, they could actually lose money on it, because they have to hold these for a certain period of time to actually make money on them. So that's something key to keep in mind for when we get to this next slide. So what does this mean for interest rates? Slide this over here. Okay, so for interest rates, how things used to be, let's say if interest rates were 8% at some time in the past, how it used to be was, if interest rates were 8%, you could get a 8% interest rate, and you didn't have to pay any discount points for that interest rate. And so we called that a par rate. You don't have to pay discount points. You just get an 8% rate. Now, if you wanted a 7%, you could buy it now, meaning you pay money to get a lower rate, but you could get the 8% at no rate or at no discount points. So now that 8% interest rate is going to cost you $3,780. This is an actual number. I pulled rates today and drew up a scenario for an individual with, as you can see here, a 700 credit score that was purchasing a $350,000 home with 3.5% down under an FHA loan. And 8% interest rate would cost that individual today, because interest rates change day to day to day. So for today, that an 8% interest rate would cost that individual $3,780. So there is no par pricing right now, meaning there's no interest rates that you can get right now for most lenders that are not going to cost you something. The reason for that, I'll go back to the previous slide, is because, again, these investors do not believe that interest rates are going to stay at 8% for long, and they need to hold these mortgage-backed securities for a certain period of time to break even, and then even longer to make money. So because of that, and because they don't believe that they're going to hold them as long as they need to hold them to be able to make the money that they need to make on them, they are charging that money up front. So when you get an interest rate that's costing you $3,700, or they're like, oh, it's $5,000 for that 7.5% interest rate, whatever it might be, this is why. It's because these investors need to make a profit on their investment. And so if all of the uncertainty in the market is causing investors to want to shy away from mortgage-backed securities, one of the things that happens, again, when people shy away, is like Fannie Mae, Freddie Mac, okay, we'll drop in the price of mortgage-backed securities. That's going to raise interest rates. But investors are also still not believing we're going to be holding these for long, because they're like, if interest rates drop next year or the year after back to 6%, then people are going to refinance, and we will have only gotten a year and a half or 2 years at 8%. And then they refinance and we don't get anything else. So we barely broke even, or we didn't make much money off of it. So again, they charge those discount points up front so that they can make money up front, not knowing what's going to happen years from now, or a year from now even, with these interest rates. So that's how that's working right now. And why, I just explained the why, because investors believe that mortgages will be paid off early and they want their money up front. So what is it that you can do to help affect your ability to be able to buy a home despite the interest rate environment that we're in right now? Seller concessions. So you can negotiate for the seller to pay concessions in the purchase and sale agreement. 6%, sellers can pay 6% in concessions for a FHA loan. So you can negotiate in the purchase and sale agreement for the seller to cover some of that money, or some of that cost, rather. Now, if the seller is not wanting to come out of pocket, let's say 3% even, to help cover some of the cost of what you have to pay for an interest rate, or helping you buy down your interest rate, then you can, if the home will appraise for a higher price, you can increase the purchase price and still have the seller pay for it, because the seller will get their money back. So they're going to net the same. For example, let's say that a seller is going to net $100,000 from their sale, for the sale of their property. And you're like, okay, I want you to help contribute $8,000 toward me buying down my interest rate, or me just paying for the interest rate that I'm gonna get. The seller might agree to it if you're able to negotiate and say, yep, I'll kick 8,000 in, and the seller will settle for $92,000 that they'll net. But maybe the seller's like, nope, I want the full 100,000. I don't want to, give you 8,000. If the home will appraise for $8,000 more, then you can increase the purchase price $8,000 more. And that way the seller still pays for your interest rate buy down. That cost was now going to be financed into your loan, and the seller's still going to net the same, because now they're not going to get the 108 because they're going to give you the 8, but you can finance that instead of having to come out of pocket if you don't have that money to come out of pocket to be able to make that payment. So seller paid buy down is another way that you can also affect the interest rate. Seller paid buy down, for those of you who might not know what a buy down is when you have, let's say, you have, I guess the best way I can put it is, you have a note rate. The note rate is the rate that you are qualified at. So if the rate today is 8%, and let's say you do a 2-1 buy down, what that means is that for the first year of your loan, you're going to pay a 6% interest rate, which is 2 percentage points lower than the 8% that is the note rate. For the second year, you're going to pay 1% less, which is 7%, which is 1% lower than the 8% note rate. That's a 2-1 buy down. 2 percentage points less for the first year, 1 percentage point less for the second year, and then you pay the full 8 for the third year on throughout the remainder of the mortgage. This is something that's paid for by the seller. And a lot of times when you have a seller who has a house that has not been moving, they might be open to negotiating a 2-1 buy down, because this, in many cases, can be cheaper than the seller reducing the price of the home by $10,000 or $15,000. So not only can it be cheaper than the seller reducing the home price, it can also be more beneficial for you as a home buyer, because your monthly payments for those first 2 years are going to be less. You still have to qualify for the mortgage at the note rate, the higher 8% note rate, but for those first 2 years, you're saving a lot of money on your monthly payments. So that's another way that you can kind of get around all of the interest rates and everything as well. So moving on, let's talk about new construction. So there are some things that builders are able to do, because when they're building the home, they can price a lot of stuff into the cost that you pay for the house. So a lot of times when you're purchasing a new construction home, and new construction meaning you have a builder that's building a subdivision of new homes and you're purchasing one of those new homes. I'm not talking about you building a home from scratch. I'm talking about a builder that's already building homes and you're purchasing those new construction homes. So a lot of times with that, those builders can offer reduced interest rates. A lot of times they either have in-house lending, or they might work with a preferred lender that they have. So in many cases, you can also allow, they will also cover your closing costs. I've heard of builders offering up $15,000 to cover closing costs, $5,000, $10,000 to cover closing costs. So these are things that sometimes builders are able to do depending upon where they're building the home, how much they're building the home for, what they're able to price into the home. Now, again, it's important to keep in mind that these are not freebies that the builder is giving you. They're not just giving you, here's $15,000 worth of free money. No, they're pricing all of this into the home. So when you pay for the home, in many instances, you are paying for all of this that they're giving you. It's just that you don't have to come out of pocket with a lot of that money because the builder is able to finance this into the purchase of the home. You still have to come up with your down payment money. The seller cannot, or the builder, they cannot cover your down payment for you. So you still have to have money for the down payment. But in many instances, there are instances where they can help with a reduced interest rate or help cover some of those closing costs and not cover all of the closing costs. So they can also help buy down your interest rate as well. So builders also have the ability, if you wanted to put more money down, they can buy down your interest rate as well. So with builders, these are some statistics from the National Association of Home Builders. So these are a little bit dated. They're less than a year old, but they aren't the most recent. Some of these numbers are actually a little bit higher now than what you see here, but 29% of builders paid closing costs and fees for home buyers. 27% offered options or upgrades at no cost or reduced cost to the home buyer. So you have 26% that reduced the buyer's interest rate temporarily, which again is the temporary buy down that we talked about earlier. And 24% paid to reduce the buyer's interest rate permanently, which means that they permanently brought your interest rate down so that that was the interest rate that you had for the life of the mortgage. So you do have some negotiating room. And again, it all depends upon how quickly these homes are moving, what the demand is for these homes. Builders need to get their money back when they're spending all this money to put these homes up. And if they are not selling homes like they would like to be selling homes or need to be selling homes, sometimes there's some wiggle room in there for you to be able to negotiate maybe a lower interest rate or negotiate having your closing costs paid, or having those closing costs and fees paid, or maybe some upgrades that you want to the home. But I would personally focus on things that affect my mortgage payment and my monthly payment, because that's where you're going to get the most bang for your buck. So ways that you can help yourself: work on your credit score. Take a moment to just look at these numbers. So as we discussed earlier, this is off the same scenario, a $350,000 house with 3.5% down, over a 30-year mortgage at an 8% interest rate. If you have a 700 credit score, just for today, because these are going to change tomorrow, so just for today, you would have to pay $3,780 for that 8% interest rate. But if you had a 600 credit score, you've got to pay $6,787. So you're paying over $3,000 more for the same rate because your credit score is not as good. This is how you can help yourself. Work on that credit score, because if you had that 700 credit score, you could actually get a 7.75% interest rate for less than the cost of what it would cost you if you had a 600 credit score, meaning you could still pocket $1,300. So if you had a person with a 700 and a person with a 600, the person with the 700 could get a lower rate and put $1,300 away, vice the person with the 600, which has got to put down over $6,700 for an 8%. So again, despite what you hear from Dave Ramsey about don't worry about your credit score doesn't matter. Your credit score does matter. Your credit score, you can buy a house without a credit score. He's absolutely right about that. You can totally buy a house without a credit score. It will cost you, and you get charged as if you had a low credit score, not a high credit score. So if you have no credit score, you can purchase a home, but you will pay for it as if you had a low credit score, not a high credit score. So it costs you when you don't have good credit. So please do work on your credit score, because this can help you tremendously with being able to save money and open up options and opportunities for you, especially when it comes to down payment assistance, if that's something that you're needing, because a 600 for many down payment assistance programs is not going to cut it. You need to have something higher than that. A lot of times upwards of 620 for the Georgia Dream program, for example. You need to have a 640 and higher. And the higher you go, the more opportunity it opens up for you. So that's one way you can help yourself. Another way, pay down your debt. Paying down debt helps to lower your debt to income ratio. And lowering your debt to income ratio really does a lot in terms of increasing your purchasing power, the amount of home that you're able to purchase. And it can also allow you to be able to save money when you're not having to put as much money towards debt. You can put more money into savings. So how does saving money also help you when it comes to interest rates? If, for example, you put 3.5% down, your 8% interest rate, as we have here, is $3,700. However, if you were to put 5% down, or maybe you put 10% down, the price you pay is going to be a lot lower, which means that you could possibly go down to a lower rate for the same price if you put more money down. Now, I'm not suggesting that that's the best thing for you to do. Maybe you don't have any debt, and so you do want to lower that monthly payment. Then yes, absolutely, that would be an option that you could look into to lower that monthly payment, put more money down on that home. However, if you don't have that option, or you have other debt outstanding that's going to be costing you more than 8%, maybe you got credit card debt out there, you might want to look at paying off that credit card debt that's probably going to be at like 20%, 22% interest rate, because that's hurting you a lot more than what putting more money down on the home is going to help you at an 8% interest rate. Get rid of the 22% debt first, and then let's look at put more money down for that 8% rate. Now, you don't have to be debt-free to purchase a home. You have a lot of people who have a lot of debt and still purchase homes. But these are just some things that I want you to think about in terms of how you can help yourself navigate these interest rates. A big way, working on your credit score, paying down debt, saving up some money. These are ways that you can help yourself. And like we listed earlier, seller concessions, negotiating that purchase and sale agreement, perhaps doing a seller paid buy down, increasing the purchase price, looking at new constructions if that's the route that you want to take. Now, I will say on the new constructions, you will probably pay more in taxes, because typically new construction homes, your taxes are going to be higher than if you were purchasing a resale. So that's something you want to keep in mind as well, because I have seen some outrageous taxes for new construction homes. They can get pretty ridiculous. So something you just want to be aware of and consider. Moving on, final thoughts. So if you want to wait to time the market, it will cost you more than what you will save. I don't have all the time right now to show you all the math on the truth behind this, but it will cost you more than what you will save if you are trying to time the market. So make sure that you are being proactive in doing what you need to do to purchase a home sooner rather than later. And I will say this little piece as well. If you were to have, say, for example, let's do it with supply and demand, since that drives a lot of what we're seeing in the market. If there is a limited supply of homes and the demand is not that high, then the prices for those homes are going to stay about where they are. Maybe they'll increase a little bit. Maybe you get some breaks and they decrease a little bit depending on the home and the location. However, when interest rates drop, demand is going to increase. Think about it. For every percentage point that an interest rate drops, there are millions of people that are now able to purchase homes. So if you're able to purchase a home now, that means at the current interest rates, there are other people who aren't able to purchase now at the current interest rates. But if you wait for interest rates to go down, now when interest rates go down, just even 1 percentage point, that opens it up to more people now that are qualified and able to purchase homes because interest rates are decreasing. That adds more demand to the market for the homes that are available. And what that does is it now increases the purchase price for those homes, because we have a limited number of homes. We're still in a housing shortage. We have an inventory shortage of homes. And so when you have more demand, because more people now are wanting to purchase because interest rates are lower, more people can afford to purchase. Now the demand is higher and the prices are even higher. And so that's going to increase the purchase price of what you are going to be paying for that home. Vice, if you were to pay now, where you can possibly get seller concessions, possibly get that home at a lower price than where you would in the future. Yes, you're going to pay it at a higher interest rate. So yes, it may cost you a few hundred or a few $1,000s more that you might have to pay over the next 2 years until interest rates drop. But when interest rates do drop, you refinance and get the lower rate, but you already have the house. So those several $1,000s that you had to spend over the next year or 2 years just to get the house now is going to be more than worth it, because if you wait, not only are you going to miss out on the appreciation of that home appreciating over the next year or two, and homes are predicted to appreciate at a rate of 4 to 5% over the next year, and beyond. So not only would you miss out on that appreciation, but you're also going to be paying a much higher price for the house, more than a couple $1,000s that you would have spent by getting it earlier. So again, these are some things that you really want to think about when it comes to purchasing that home. Do you really want to sit on the sidelines and wait for interest rates, or do you want to go ahead and jump in now, realizing that in the long term, you're going to be building more wealth because you're going to be saving a lot more money by acting sooner rather than later? Also, all loans are not created equal. So FHA and VA loans typically have the lower interest rate costs when compared to conventional and non-conventional mortgages. So if you were to, all other things being equal, let's say you have someone with a 650 credit score, a 700 credit score, and you put them in you price them out for a $300,000 home with, let's say they both have 5% down payment. The interest rate pricing that you will see for the FHA and VA will more often than not be lower than the interest rate pricing of what you'll see for a conventional mortgage. FHA loans, which are government-backed loans, VA loans, which is a government-backed loan, they typically have lower interest rate pricing. Now, if you have a really high credit score, let's say that your credit score is up in the 780s, it may be more beneficial for you to take the conventional route. The reason being is because you could actually pay lower mortgage insurance taking the conventional route than what you would pay going the FHA route. So even though you may pay a little bit more on the price for your interest rate, you would have lower mortgage insurance, and after the loan to value ratio, or after you owe 80% or less than the value of that home, that mortgage insurance can go away. At 78%, it automatically goes away. But once you hit 80, you can request for your lender to have it removed from your loan, so you no longer have to pay the mortgage insurance. With an FHA loan, if you don't put at least 10% down, you have to pay mortgage insurance throughout the life of the loan. And if you put 10% down, you still have to pay mortgage insurance for the first 11 years of that mortgage. So these are some things that you might want to consider as well. Again, going back to our slide where I said how you could help yourself was improving your credit score. This is another way that helps you a lot, because with a really high credit score, it may be more beneficial for you to actually go conventional and save money on your mortgage insurance, but also have a lower, have that mortgage insurance go away completely once what you owe on that home is 80% or less than the total value of the home. So maybe over the next few years, your home is appreciating, and then you're also putting equity into your home with every mortgage payment that you make. So you get to that point where, hey, now you owe much less than what the house is worth. And once you owe 80% or less than what that house is worth, you can have that mortgage insurance go away on a conventional mortgage. So these are some final thoughts that I want to leave you with. Thank you for taking the time to tune in and listen to this information. I hope it's been very beneficial for you. These are some ways that you can connect with me. I am constantly working to push out more content, because I really do have a heart to want to educate individuals on things that they can do to help themselves grow in this current market, but also for the future. to build wealth, to be able to purchase homes, to also reassess when is it time to refinance that home to accomplish some other goals that you're wanting to accomplish. Perhaps you want to pull some equity out of that home to start a business, or perhaps using that equity to size up to the next home. Maybe you get married and you have kids, and now the home that you bought or the townhome that you bought is no longer big enough to support you and your wife and your kids, or you and your husband and your kids. So you want to look at ways that you can sell this home, maybe take that equity, and maybe it makes more sense for you to take that equity and pay off some high interest credit card debt that you've racked up during this inflationary period that we're in right now. So you get rid of that. Maybe you get rid of your car note, and we take your complete debt down to just your mortgage. And you were able to accomplish all of that because you purchased the home sooner and built up all of this equity in that home from making one-time mortgage payments, maintaining and upkeeping your home. And then the market did the rest by just appreciating your home over time. So these are some things that I truly have a heart to want to help individuals and people be able to accomplish so that they can be better prepared to just start setting themselves up for success financially, building wealth generationally, and educating the next generations as well. So this is my heart. If you can't tell, it's something that I'm truly passionate about. So this is where you can follow me. I try to put up as much content as I can across these platforms so that I can just continue to just educate, and I'll continue to keep doing these monthly webinars as well. So they'll be on different topics every month to just continue to, again, educate people into making better, more informed decisions. So that's all I have for you. Thank you for tuning in. Again, I'm Frederick Middlebrooks. It was my pleasure, and I'm blessed by you just taking the time to tune in, and look forward to seeing you in the next one. Take care.